All right, here we are again. Now, I think I may have forgotten to send you the slides this week. I don't remember. I know I sent out the invitation, obviously, because you're here. So just to be on the safe side, let me just take care of that right now. Okay. Because now I'm thinking, did I or did I not? Let's find out. Okay, this thing is not responding.
Yeah, we didn't receive anything today.
Okay, all right, let me take care of that right now. Okay, let's get that going. This is week 3. Here we go. So you need, yeah, here it is. Now, also, it's not just that. There's also an Excel spreadsheet here. This week is very heavily Excel based. And so I created something called a template here, which is meant to make it easier for us to follow along these examples, because these are fairly time consuming. Not that much, they're kind of difficult, but really more than anything else, time consuming. So what we're basically doing is determining what the proper value is for a swap. So there's multiple ways of doing that, as you can probably imagine. Just like everything else in finance, there's always multiple, or often multiple ways of getting at the same result. So we're going to be looking at these structures of interest rate and currency swaps, but our main focus is on understanding how they're priced right now. We know that they all have different kinds of cash flows, but what we're really interested in is how much should you be expected to pay for a swap, and how much does the value change over time, and how is that value determined in the marketplace? Now, with every swap, there's two counterparties. So what happens is if one side gains, the other loses the exact same amount. So a swap is worth a total of 0 to the two sides together, but typically one side is ahead and the other is behind, except on the very first day of trading when the swap is first entered into. Typically, it has a value of 0 to the two sides. After that, every day, market variables will change. And so if one side starts to gain value, the other will lose the same amount of value. All right, so let's see how this works. Well, first of all, just a quick reminder, we did some of the basics a couple of weeks ago. So what we're going to be looking at first is the key features of interest rates and currency swaps, understand how they're priced in the market, learn how they're used for hedging purposes, and understand other types of swaps that trade in the market. Now, swaps are over-the-counter products, which means they're traded directly between counterparties. And that also means that, like forward contracts, they can be completely customized to the needs of the users. So literally any type of swap can be arranged as long as there's two counterparties who are willing to go along with it. And so some of the swaps you see out there in the market are actually quite unusual. And in fact, sometimes swaps can be written on purely non-financial assets, like you can trade the cash flow in, let's say, one country, or not one country, but let's say you can exchange cash flows based on changes in temperature in two different regions, or the weather, or whatever the case may be. Most of the time, though, swaps are based on either interest rates or exchange rates. And that's because these are used primarily as hedging instruments. And so, as you can probably imagine, the demand for hedging interest rate risk and currency risk is quite high. These are typically businesses that are trying to protect themselves from losses if there are fluctuations in interest rates or exchange rates. So there's a huge demand for hedging instruments, and this is one of the better ways of hedging our risk. You don't normally see a lot of speculation with swaps because they're just simply too complicated. Speculating would be much simpler with forward contracts or possibly options or futures too, I guess. So anyone who's in the market to gamble is probably not going to use swaps for that purpose, because it's just, it's hard to tell what could happen to the value of the swap over time. Whereas with a forward contract or a futures or an option, it's much easier to see how the value of your contract will be impacted by market variables. So for the most part, swaps are going to be used for hedging purposes. Now, interest rate swaps are based on the exchange of cash flows between two different kinds of interest rates. Typically, one of those interest rates is a fixed rate of interest, which never changes, and the other is typically a floating rate, which is reset on a regular basis. Now, the only example I can think of at the top of my head as far as that goes is adjustable rate mortgages, where, as you may know, an adjustable rate mortgage has a rate which starts out relatively low, and then it can change over time. Typically, once a year, it's reset by the bank. And in fact, this is how a lot of people got into trouble in the early 2000s. They took out adjustable rate mortgages with absurdly low rates that suddenly started going up very quickly. And before they knew it, they couldn't even begin to afford the houses that they bought. So, the popularity of products like that has sort of fallen by the wayside, although there's a place for them. Imagine that you're just starting out, you're at a job that you like, but you're in the early years, so your salary is not that high, and an opportunity comes along to buy a nice house. Well, you know that eventually your salary will be higher. So you may decide to get into one of these adjustable rate mortgages because you can start out with relatively small mortgage payments and then gradually they go up, hopefully not faster than your salary. But, it's not a, terrible idea. It's just that, in the late 2000s, the banks were getting very, very aggressive about trying to sell houses to people. And they were offering rates that were just so low that they had to go through the roof sooner or later. And a lot of people didn't fully understand just how much the rates could change. And they ended up not being able to pay their mortgages. Now, there do exist bonds in the marketplace that have a coupon rate which is reset periodically, and they're called floating rate notes. They do exist, but they're not nearly as common as the traditional fixed rate coupon bonds that we see in the market. Typically corporate bonds, they have fixed coupon rates. Typically treasuries all have fixed coupon rates. You really have to search to find a floating rate note. But again, you can find one if you really look. If you go to an investment bank and say, listen, I want to invest in floating rate notes, they'll find them for you. But they're much less common than fixed rate notes, or fixed rate bonds, I should say. Now, the purpose of entering into one of these swaps is that you may decide that you're nervous about the position you're in, that maybe it made sense to buy a floating rate bond 5 years ago when rates were heading down, but now you're worried that rates are heading up. And you might say, I don't want to sell this bond, but I don't want to be exposed to the risk that rates will go up. So you can enter into a swap with another counterparty who has a different outlook on the market and who might be willing to trade you one type of cash flows for another based on the difference between a fixed and a floating rate of interest. And by the way, the notional principal, we have to specify in all of these interest rate swaps, the principal that the swap is based on, because that's what determines the actual interest payments. So in other words, it makes a great deal of difference if the swap is based on $1 million or $100 million. And that has to be determined when the swap is first entered into. And so whatever interest rate we're supposed to pay would be applied to the notional principal to determine how much each side pays and how much one side pays and how much the other side receives. Okay. Because eventually the cash flows are traded between the two counterparties. Now, having said that, we don't actually see the full trading of those cash flows. They only trade the differences between them. So the one side basically who has a larger payment than the other side sends the difference to the other counterparty. So we'll see that as we go along. So we start with the most common type of interest rate swap, which, by the way, there are many others as well, but this is the one you see the most often, the so-called fixed for floating rate swaps. And so what's happening is that we choose a fixed rate of interest and a floating rate. And the floating rate until recently would have been tied to LIBOR. And that is the rate at which the major London banks borrow short-term funds from each other. Now, I'm not sure if LIBOR is going to completely disappear, but it's not going to be used in derivatives contracts for long because of the scandal with the banks that were manipulating it to try to make profits at the expense of their clients. Now, I don't know if anyone actually did jail time or not, but let's just say that it caused the markets to think, maybe we need to do something different rather than using LIBOR because it's so easy to manipulate it. And so in order to avoid that, a group of new rates are going to be introduced very soon that will be underlying swaps in each different country. I think I may have mentioned that for the United States, we have this rate created by the Fed. That would be this thing called SOFR, and it stands for oh boy, where is it? All right, well, this is a terrible article. I guess, oh, there it is. Secured overnight financing rate. It's a benchmark interest rate for dollar-denominated derivatives and loans that is replacing LIBOR. Look at this. Interest rates on more than $80 trillion in notional debt switched to SOFR in 2020, October. This is Investopedia, good. So it is based on transactions in the treasury repo market and is seen as preferable to LIBOR since it is based on data from observable transactions rather than on estimated borrowing rates. Right, because the LIBOR was a little different. It didn't have to be based on actual transactions. They were just quotes from the 16 largest London banks. And what they would do is they would take, they would drop out the largest and the smallest quotes, and then they would find some kind of an average of the 14 remaining quotes and use that as LIBOR. And so the problem with that, of course, is that it's not a true market rate of interest because it may be that nobody's actually borrowing at that rate, that they're borrowing or lending at a different rate, but they're averaged all together. And you end up with this LIBOR, which is sort of a mixture of all the different banks' borrowing and lending rates. Now, this is unique to the United States. Before, there was a LIBOR for every currency, every major currency. Here now, we have a different situation in our hands. Every country has to create its own benchmark floating rate. Like here in the US, SOFR is what's coming out, but the other countries will have their own equivalent version of that, which will all have their own different names. It's going to be hard to keep track of them all. It was so easy before. You could just say, well, this loan is based on dollar LIBOR, or this other loan is based on British pound LIBOR, or something like that. Now we have to, look for a list. Let's see if we can find a list. Oh, oh, here we go. So this is same, of course, the Chicago Mercantile Exchange we've already discussed is basically the country's largest derivatives exchange. Now, the reason why they care about this is because they're going to be selling derivatives whose values depend on these alternative rates of interest. So that's why they're big on top. They need to be on top of this very quickly. So let's see. Oh, I was hoping they would have a list of the other countries' versions, but I guess not. They're probably at the moment only planning on carrying US dollar-based contracts. Well, all right. I mean, oh my God. Let's see, maybe this is it. Euro interbank offered rate Euribor, Euro overnight average index EONIA, and other interbank offered rates. Okay, so some of them are still being used. They've got to the end of the year, it looks like, for these other currencies: sterling, the euro, the Swiss franc, the Japanese yen, even some US dollar rates, only 1 week and 2 months. And then for US dollar, June 23, US dollar overnight, 1 month, 3 months, 6 months, and 12. And then that's it, they're completely gone. Oh, here we go. Certain currencies use other benchmarks. Oh, here we go. So the dollar will use SOFR. The pound will use SONIA, sterling overnight index average. The euro will use ESTR. Oh, I guess that would be pronounced Esther. The Swiss franc is Saran. The Canadian dollar will be Cora. Oh. Well, you can see it's going to be confusing for a while. It's so sad. I mean, it was so easy with LIBOR, and LIBOR had been around since the 1950s. And so everyone was so used to it, and it, so many different contracts were tied to LIBOR. It made things so easy. And there you go. Well, what are you going to do? You're going to have crooks in every business, and you just have to try to minimize their impact. So in these slides, we're going to continue to assume that LIBOR is still being used, and you can see that it is in some cases anyway. Later on, of course, they'll be different. So LIBOR is designed to show the rate, or at least the average rate, at which the major London banks borrow funds from each other. Now, with an interest rate swap, we never actually trade the notional principal. There wouldn't be any point because it's the same amount for both sides. So trading them would be kind of senseless. So it's really just the net difference in the interest payments that are being traded. So what that does is it heavily reduces the credit risk from these products. So that's one of the reasons why they're structured this way, because one of the biggest issues, as you know, with over-the-counter products is credit risk. We worry that the counterparty to this transaction will not be able to carry out their obligations in a timely manner. And if that happens, there isn't a whole lot we can do. We can take them to court, but we may never see the money. So we want to do whatever it takes to minimize the credit risk of these products. And that's one of them, to only trade the differences between the cash flows and never trade the notional principals. Now, in a fixed for floating rate swap, there are two rates. There's the floating rate. The fixed rate is often referred to as the swap rate. It never changes. The floating rate can change on a regular basis, although in many cases it's going to typically be every 6 months or a year, although you could organize it or arrange it any way you like. That is the most common type you'll likely see, every 6 months, every year. So a quick example, a corporation has issued $100 million worth of debt. The maturity is 5 years. The coupon is LIBOR plus 2%. No, so they're issuing a floating rate note. Why are they doing this? Well, they're pretty sure that rates are heading down in the immediate future, so that if they're right, they can save on interest by paying a progressively smaller amount of interest. If LIBOR goes down, then the cost of borrowing goes down too. Now, of course, it might go up, and that's where the problem is. Now, what if this corporation suddenly thinks, you know what, maybe this wasn't such a smart move, because now we're starting to worry that maybe rates are heading up. So what can we do about it? Well, we can sell. Well, we can't. No, I mean, we can't do anything really, because we sold these bonds to the public. We can't ask for them back. But what we can do is enter into a swap in which we trade our exposure from floating rates to fixed rates. So we're going to enter into the swap with the dealer, and we'll see the diagram in a second, by becoming the fixed rate payer, which implies the floating rate receiver. So you have to be on one side. The floating rate, you're going to pay one and receive the other. That's what you have to specify when you get into one of these swaps. Do you want to be the fixed rate payer or the floating rate payer? And in fact, the swaps are typically characterized by what kind of payer you are, because it's understood once you know what kind of payer you are, that tells us what kind of receiver you are. All right, so here's a quick example. Now the corporation agrees to pay to a dealer 6%. Now that would be based on this $100 million notional principal. That's the notional. To a swap dealer in exchange for LIBOR every year for 5 years. All right, so the down arrow to the bondholders, that's the LIBOR plus 2% that we promised them. We're now getting into the swap with the dealer. They pay us LIBOR and we pay them 6%. So again, the actual transactions, and let's just, by the way, let's just keep it simple and assume that this happens once a year. So if LIBOR exceeds 6%, the swap dealer pays the difference to the corporation. And that's, of course, based on the notional. So if the difference is 1%, it would be 1% of $100 million or $1 million. On the other hand, of course, if the LIBOR is less than 6%, the corporation pays the difference to the dealer. All right. So now, of course, if they're equal to each other, then no cash flows take place at all. So the big question becomes, what is this getting the corporation? Why are they doing this? Well, if you look at the cash flows that are coming into their pockets and going out, the corporation pays LIBOR plus 2 to the bondholders, plus another 6 to the dealer, minus LIBOR, which they receive from the dealer, which means all of a sudden, instead of paying LIBOR plus 2%, they're paying a guaranteed 8% per year, regardless of the level of LIBOR in the marketplace. And so the risk is gone. You've locked in an 8% rate of interest. Now, it's possible that if LIBOR goes up, they'll be very pleased. But if LIBOR goes down, it means they could have saved a little interest, but they don't care because think of this as an insurance policy. All right. It's like, you know, when you buy insurance and you never use it, you figure, well, you know, I had to have it. So 8% is what they're locking in. The dealer is most likely entering into another swap with another counterparty. The dealer's job is to offset all their risks in the market. And then what they're essentially doing is they're lending money at a higher rate in the swap market and they're borrowing at a lower rate. And so the spread between the two, as we'll see in a few minutes, is where their profits are coming from. But they have to make sure that they've hedged away all their risks to avoid losing money if interest rates move in the wrong direction. Okay. So now this is what I was referring to. The dealer, having entered into the swap, enters into a 5-year swap with a bank, which the dealer is paying 5.95% in exchange for LIBOR. So you can see the dealer is still making money no matter what happens to LIBOR because they're collecting 6 and they're paying out 5.95, whereas the LIBOR exposure is 0 because they're collecting and receiving it. So the dealer locks in a profit. Now, again, this is net of any credit events that might take place of 0.05% times $100 million, which is $500,000. That's not bad for a day's work. Once they have themselves set up in these two swaps, they're guaranteed. Now, this is not going to, actually, this is every period. In other words, if this is a 5-year swap, they're going to make this every year. Okay, I mean, if these are 2 5-year swaps. So the dealer makes their money by offering less interest and receiving more in exchange for the same floating rate. So that's, yeah, don't worry about the dealer. The dealer will head, and you notice the dealer is facing no risk. It doesn't matter what happens to LIBOR, they'll collect as much as they need to pay to the corporation. So they've eliminated their risk by entering into this new swap with the bank, and they've locked in this 0.05% profit, which is not bad for a $100 million swap. All right. Now, this is a set of quotes that you might actually see from a dealer. This is how they would normally express their quotes. They're not normally whole numbers or constant numbers. Here's what they might do instead. So we've got swaps. The dealer is willing to enter into swaps of maturities from 2 to 5 years. And you've got a dealer pay and dealer receives, but you notice it's not a fixed amount of interest. It's basically a spread where TN stands for Treasury Note. Treasury notes, by the way, have maturities from 2 to 10 years. They are completely safe. These are issued by the US government. And the range is from 2 to 10. So what they basically do is the starting point is the yield on that equivalent Treasury security. Plus now BP here stands for basis points. And the way that works is I'll move it down here, 1% equals 100 basis points. It's a convention in the markets to call them basis points. So here the dealer says, if you want to enter into a swap with us, you'll give us 2-year Treasury note yield plus 28 basis points, which in this example means 2.28%. But they'll pay you 2.20%. It's the 2-year Treasury note rate plus 20 basis points would be 0.2%. 28 basis points is 0.28%. So you can see every transaction, they're making a profit of 0.08% or 8 basis points. That's their profit. In other words, this is the only reason they're willing to do these trades with you, because they expect to make money. That's it. So every one of these quotes is based on the current Treasury note yield plus some fixed amount of basis points. And if you notice the spread between the two, 8 basis points, then we have 9, then we have 10, then we have 50 down here, because the longer the swap goes on, the more credit risk there is for the dealer. So that's why the spreads get wider as the maturities are increasing. All right, now let's look at this case. A U.S. corporation issued $100 million worth of 10-year 6% bonds 5 years ago. Coupons are paid annually. The corporation expects rates to fall in the future and would like to transform this fixed rate liability into a floating rate liability. So they would like to be paying somebody floating rates instead of fixed rates. Well, what do? Well, they enter into a swap in this example, in which they're paying LIBOR in exchange for 4%, based, of course, on the principal of $100 million. So this is what it ends up looking like. They're paying 6% to the bondholders down here. They're paying LIBOR to the dealer, who in turn pays 4%. So the corporation pays 6% plus LIBOR, but then they collect 4%. So their net payment is 2% plus LIBOR. So they're in the position they hope to be in, meaning that they're paying LIBOR, or a floating rate, I should say. And that means that if rates drop as they predicted, that means they could save some money. Now, naturally enough, that means that if they're wrong, they can end up paying a lot more interest. Okay. So that's what they've done, though, is they've traded their fixed rate exposure for a floating rate exposure. And they've done this intentionally because of their outlook on interest rates. They really believe that rates are heading down and that this is a good opportunity to save some money. And, because they can't very well turn around and say to the bondholders, listen, we changed our mind. We want to pay a floating rate. It's too late by then. They're in the contractual obligation to pay 6% to the bondholders. So this way they can change what they've set out for. And it's easy and convenient for them to do this. Okay, now, comparative advantage, sometimes we may find discrepancies between markets where you can borrow fixed or borrow floating. We're assuming that we can borrow fixed or floating. These are two corporations, and if they go into the market, they've been told that they can borrow fixed for 5% or floating for LIBOR plus 2. XXX is either asked to pay 7% for fixed, LIBOR plus 3% for floating. So clearly, ABC is the more creditworthy of the two corporations. But interestingly enough, their advantage is different in the two markets. In other words, XXX pays only 1% more in the floating rate market and 2% more in the fixed rate market. So when the two corporations notice that, they can get together and find a way to reduce their borrowing costs and split the profits between them if they know what they're doing. The logic is that each one, and by the way, because in the fixed rate market, ABC can save 2% compared to XXX, but only 1% in the floating rate market. The terminology that we'll use is that ABC has what we call an absolute advantage in both markets, which means they can borrow more cheaply in the two markets due to their credit rating. But their advantage is more pronounced in the fixed rate market, 2% versus only 1%. So in economics, we call that comparative advantage. And that means where's our advantage most pronounced? And that would be in the fixed rate market. So here's what we're going to do. We're going to have ABC borrow in the fixed rate market. XXX will borrow in the floating rate market, and they will trade cash flows with each other. And by doing so, they'll both save some money on their borrowing costs. So imagine that here we go. So ABC will borrow in the market where they have their competitive advantage, the fixed rate. XXX borrows the floating rate at LIBOR plus 3. Then they get together and say, all right, ABC will pay LIBOR to XXX in exchange for 3.5%. So let's take a look at this graph. It's so much easier. So ABC borrows fixed. XXX borrows floating. Now, you can see what's happening is that they're trading. ABC is paying LIBOR to XXX in exchange for 3.5%. So ABC pays 5 plus LIBOR minus 3.5%. Or LIBOR plus 1.5%. Whereas XXX pays, they're paying LIBOR plus 3 for their loan, plus another 3.5% with a dealer, and then they get repaid LIBOR. So they're paying 6.5%. Now, how does this help them? Because, and this is again repeated in the next slide, ABC would have had to pay LIBOR plus 1.5%. Sorry, 2%. If you remember that chart we had, 2% to borrow a floating rate. And XXX would have had to pay 7% fixed to borrow at a fixed rate. So guess what that means? Each of them saved 0.5%. Well, that's not too shabby. And all they had to do was get together and make this arrangement. They're basically borrowing in each other's areas. The markets, they're borrowing in the area that the other one wanted to borrow, because ABC wanted a floating rate and XXX wanted a fixed rate, but it did not make any sense for them to borrow directly. By making this arrangement, they've not only transformed their liabilities into something they prefer, but they're also saving 0.5%. All right, let's see, what do I have here? Yeah, I mean, this is a more formal chart, but you get the idea. It's the same exact thing. I just did it more informally. This wonderful chart shows everything you need to know to determine how much the two sides saved. Now, of course, in practice, you wouldn't really expect to see this happening, because it would indicate that there are noticeable inefficiencies in the market for loans denominated in LIBOR, but you never know what can happen. Okay, the markets are not perfectly efficient, so something like this could actually happen. All right, now we're going to get to do some pricing. How are we valuing these interest rate swaps? Well, the price of a fixed for floating rate swap equals the difference between the present value of the cash flows from the fixed rate side and the present value of the cash flows paid from the floating rate side. That's all there is to it. The differences between the cash flows, we have to calculate their present values because they take place at different points in time. Okay, so let's see how that works. By the way, when these are entered into, usually, not always, but usually it's set up to ensure that the value is 0 to both counterparties. After that, it can change every day because the floating rate can change. The fixed rate can't change, but the floating rate can. So we start out with an agreement which has the same value to both sides. Therefore, the value is zero, but that will change right away, almost right away, when the floating rate starts moving around. All right. And of course, as we've already discussed, the price to one side will be positive, the other will be negative. They always add up to zero. And of course, if you're the fixed rate payer or a floating rate receiver, then interest rates going up means that you are happy because you're receiving the floating rate that's going up. If you're the floating rate payer, you're not happy at all. Okay. And of course, falling rates cause the opposite effect. All right. Now, it turns out, like I was saying before, there's so many different ways of getting it to the same results in finance, but there are two equivalent ways of pricing an interest rate swap. We can treat the swap as the exchange of a fixed rate bond for a floating rate bond, or we can treat the swap as a portfolio of forward contracts written on interest rates. And by the way, these have a special name of their own. They're called forward rate agreements, FRAs. Forward contracts written on a rate of interest are called forward rate agreements. An interest rate swap is equivalent to a portfolio of these forward rate agreements that mature at different points in the future. So we can think of this in either way, and we'll end up with the correct results. Now, this is, by the way, where the Excel is going to come in. So let's say 6 months ago, a 4-year fixed for floating rate swap was entered into. The notional principal was 100 million. The floating rate is 1-year LIBOR, and the swap or fixed rate is 5%. The payments are exchanged annually. Now, by the way, the reason why we have to do it this way is because if we started today, the price of the swap would just be zero. Okay, this way, we know that it's not necessarily zero. All right, so how would this thing be priced? The swap can be treated as a portfolio of bonds by treating the fixed rate payer's position as buying a $100 million floating rate bond. Again, let me remind you on the top here, this is the fixed rate payer. And so remember what's happening. They're paying a fixed rate and they're receiving a floating rate. So if they bought a $100 million floating rate bond, that means they're receiving LIBOR. All right, remember, this is also a floating rate receiver. Now, they're paying for this bond by selling, we're assuming that this is possible, a $100 million bond whose fixed coupon is 5%, which means they have to pay 5%, and they will receive LIBOR every 6 months, or in this case, every year. Now, if you notice, there's no mention of the principals. That's because they exactly offset each other. So all that remains is the pattern of cash flows with the interest payments every year, receive LIBOR, pay 5%. That represents the cash flows to this swap. And that's how we're going to price it. And of course, the floating rate payer has the exact opposite position. Okay, so we're just going to reverse these two. The floating rate payer is buying the $100 million bond with a fixed coupon and financing it by selling a $100 million floating rate bond whose annual coupon is LIBOR. All right, so therefore, if the price of this fixed rate bond, this fictional fixed rate bond, exceeds the price of the fictional floating rate note, the swap will have a negative value or price for the fixed rate payer and a positive price for the floating rate payer. All right. Because the fixed rate payer, let me just quickly remind you, is short. Remember, let me just go back and remind you where we saw this. They're short the fixed rate bond. And when I say short, that means they've sold it, and they're long because they bought the floating rate bond. And so as a result, the price of the fixed rate bond is higher. That means we are behind. All right, in other words, it would be like being short $100 but long $90. That means we have a negative position. Now we can do the same thing with the floating rate pairs. Everything here is reversed. Floating rate pair is long the fixed rate bond, meaning they own it, and they're short the floating rate bond, so if the price of the fixed rate bond is higher, we're long the higher, the more valuable bond. Therefore, our position is positive. All right, so hopefully that makes sense to everyone. And again, we'll see this when we go through the examples in Excel. All right, now, what we're going to do is now start to show how the prices are determined for the fixed and the floating rate bonds. Now, this is where it gets a little odd. This is because John Hull's book, he just loves continuously compounded interest rates. So what exactly is that all about? I don't think we went through this, did we? Let me just quickly show you what that's all about. Suppose that a bank pays 5% interest. Compounded annually. For 1 year. That means that we get paid at the end of the year for 5% based on our balance in the account. So $1,000 would be worth, and it would just simply be 1,000 times 1.05 equals 1,050 at the end of the year. If the compounding frequency rises to semi-annual, $1,000 would be worth 1,000. This time it's 1.025 squared. And that equals about 1,050.625. Now, what happened there is that the increased compounding frequency causes us to earn interest on our interest during the year. Now, it's not a lot, but it's enough to increase the value of our deposit at the end of the year. And in fact, you may have heard these terms before. In the first case, the deposit is worth 1,050. Of this, $50 is total interest. This is also known as simple interest because it is entirely based on the principal. In the second case, the deposit is worth 10,050.625. Of this, 50.625 is total interest. 50 is simple interest. Remaining 6.625 is compound interest, it's called. Now, what exactly is compound interest? Well, that's an interesting case. That is interest on interest. All right, so I'll just throw that in here too. Interest on interest, okay? As the compounding frequency increases, simple interest remains unchanged, while compound interest and total interest increase. For example, with quarterly compounding, the balance is 1,000 times 1.0125 raised to the fourth power. Which is slightly higher. $1050.95. So we keep increasing, and I'll put in parentheses of which, of course, 95 cents is the compound interest. So what is this leading up to? Well, in the limit of this process, continuous compounding, where interest is paid at every interest instant in time. In other words, interest is compounded an infinite number of times during the year. The balance in the account when interest is 5% per year compounded continuously is, and so it's not going to be what you think. It's not, we're not going to use that same formula. Instead, what we have here is 1,000 times E, which you may have seen before, is raised to the 0.05 power. Okay, here we go. And that equals $10.5127. $1.27 is the compound interest. Okay, so in other words, what you're seeing here is that every time you increase the compounding frequency, the total interest is growing because the compound interest is growing, not the simple interest. So in finance, it's especially with the derivatives markets, it's often convenient to use compound or continuously compounded rates of interest. Now, it's not common in certain markets. For example, in the bond markets, you do not normally see continuously compounded rates of interest, but you often see them in the derivatives markets. Now, Hull's book, he just loves continuously compounded rates of interest because they have a lot of wonderful algebraic properties. So he tends to use them even when you wouldn't see them in the marketplace. So we just have to get used to him using continuously compounded rates for just about every application out there. So this is no exception because we're going to see that the interest rates we're given, the LIBOR rates are assumed to be continuously compounded. So what this chart is telling me that in 6 months, LIBOR, well, the 6-month LIBOR rate is currently 4%. The 1.5-year LIBOR rate is 4.5%, et cetera, all the way out to 5.5% for 3.5 years. Now, why are we looking at these half years? Because these all mature in even time in the future, because remember, this swap was sold 6 months ago or half a year. So let me go back and find the details again. Let's see. So here it is, 6 months ago, 4-year fixed for floating rate swap was entered into with a notional of $100 million. The floating rate is the 1-year LIBOR, the swap rate is 5. Okay. And it's assumed that the cash flows are, yes, annually. Okay. So basically what's happening here is that if we could draw a little diagram. Let's try that. So let's say this is today. Now, normally with these timelines, the time index is usually set at 0 for today. So this means that I guess we could call this negative a half a year ago, or half a year ago was when the swap was entered into. This is today. And now in 6 months or 1/2 a year, the first exchange of cash flows will take place. And we have here it is. The swap rate is 5%. And on the floating rate side is LIBOR. And then a year later, at what we will call time 1.5, this is the next exchange of cash flows. And then this is the last one. So of course, it's the difference between the two that will be traded between the two. Now, here's an important detail. This LIBOR was set 1 year earlier at t equals -0.5. This one was set 1 year earlier at t equals 0.5. This one was set at t equals 1.5. And this one is set at t equals 2.5. In other words, on each of these dates, which are, by the way, these are called reset dates, where the new floating rate is determined, that rate on t equals 0.5 determines the LIBOR rate that will apply in 1 year when the cash flows are traded. So the LIBOR rate we're looking at today was based on what happened last year. And so that's why we need these rates. Now, these rates are determined in this chart to be 4%. Let's see, 4.5, 5, and 5.5%. So given that we have this term structure of LIBOR rates, as of today, this is what we would see for these cash flows. Now that could change, but right now that's what they're worth. And so you can see that in some years, the fixed rate is higher than the floating rate. In other years, it's the other way around. So with all this information in place, how can we determine today's value of this cash flow? Now, oh, and one more thing, don't forget, the notional is $100 million. And what else do we need to know? I think that's about it. So what we're going to do, right as of today, with the current term structure of LIBOR rates, we're going to price the bond by comparing the 5%. And of course, 5% of 100 million is $5 million. We need to know these floating rates. So we're going to, oh, and by the way, 5 million is the coupon. So wait a minute, hold on a second. Oh, no, this is the fixed rate side, sorry. I thought, okay, no. So the price of the fixed rate cash flows now, also, I want to point out here that because we're treating these as bonds, in the last period, these cash flows, 5% of 100 million is 5 million. But in the last period, you also get your money back from this bond. So the cash flows from a fixed rate bond would be 5, 5, 5, and 105. So all we want to know is what is the present value of these 4 cash flows based on these LIBOR rates. We're going to discount all of these with LIBOR rates. So now calculating present values with E is a little bit tricky. It may not be what you're used to. Okay, so let me just show you how that would be done. So in each of these cases, this is the LIBOR rate, and this is the time. So in other words, the 6 months from today LIBOR rate is 4%. Okay, then the LIBOR rate 1.5 years from today is 4.5%, and the time is 1.5 years in the future, and so on. And remember, in this last case, we've got 105 instead of 5. Now, when you calculate the present value with E, the present value equals the notional principal. I'll call that P, e to the minus RT. This is the principal. This R, of course, is the annual rate. And this T is the time in years. That's how you calculate. And you notice that's what's happening here. We take the cash flow, e to the minus, and then we have the rate of interest, the LIBOR rate, and then the time. And they add up to 100.59 million. Now, because the notional is 100, this indicates that the swap at the moment has a positive value for the, let's see. This would be the fixed rate. Hold on a second. Let me just go back and look. Actually, we can't tell yet. I just realized we have to look at the floating rate side before we determine whose cash flows are greater than the other. So instead of trying to figure that out, let's go ahead and price the floating rate side. And then we'll compare the two, and then we'll be able to tell which side is ahead and which one is behind. Okay, but remember, from way back up here, the fixed rate payer is short the fixed rate bond. Okay, so fixed rate payer is short the fixed rate bond. So in other words, they owe this money to somebody else. The opposite is true for the floating rate payer. So the next step, they're short along the fixed rate bond. Okay, now the floating rate bond, now this is a very strange result. You're going to be very surprised by this. Based on this diagram. Well, all right, let me just show you what this is all about. Suppose, let's create a timeline. We have a security of some kind. And remember, the LIBOR rates are determined 1 year in advance. So let's say here LIBOR at time 0 is 5%. And let's say the notional is 100 million. Well, that implies that here at time 1, the coupon is 5%. Or in this case, $5 million. Okay, now here at L1, let's say this is 4%. The coupon in year 2 is going to be $4 million. Okay, now, and then of course, I guess we'll do another example. L2 is, let's say, 3%. And then we don't need this one. All right. So now keep in mind The notional is always $100 million. So on date one, the owner of this bond has a bond worth 100 million plus a $5 million coupon. How much is it worth 1 year earlier? So in other words, the value of this bond at time t equals 1 would equal e to the minus 0.05. Actually, no, for this, we're going to have to use discrete rates of interest. That's why this is so confusing. 105 is the total value of our position. 100 million. But only right here when the interest rate has first been determined. After that, at any day in between here, the price of the bond could be anything. So what we're trying to get at here is that on each reset date, the bond is worth the notional principal which in this case is $100 million. All right, so that's what this next part is all about. So therefore, let's come down here and draw another picture. Six months ago, the swap was entered into. The fictional bonds were being bought and sold. Now, let's just say here the LIBOR rate was 3.5%. So the coupon is 3.5%. That means we receive $3.5 million. But the bond is assumed to be worth 100% that is. So what they're going to do is say, well, guess what? As of today, the bond that has a face value of, in this case, 100 plus a $3.5 million coupon is worth today to us the present value of $103.5 million. Remember, this LIBOR is 4%. So we're using that to discount our cash flows back to the present, which is 6 months. This 3.5 is 6 months in the future. So to bring it back to today, we need half a year. So the present value today is 101.45. So this is the price of the floating rate note in our swap. All right, so we've already figured out the price of the fixed rate note. So what this means is the following. From the perspective of the fixed rate payer, this is the floating rate bond. And this is the fixed rate bond. And the difference between them is positive at $86 million. Remember, We're assuming that the fixed rate pair is long the floating rate bond and short the fixed rate bond. Whereas with the floating rate pair, it's the other way around. We're long the fixed rate bond and short the floating rate bond. And so you see, it's just the opposite. It's the negative of the value for the fixed rate pair. The two of them have to add up to 0. Okay, so the floating rate bond is worth more than the fixed rate bond. Which implies the swap has a positive value for the fixed rate pair which means it must have a negative value for the floating rate pair. But the two of them have to add up to 0. Now, this is where the Excel is going to get involved. I know you're getting impatient to use Excel. I am too. I want to use Excel. So this is how we're going to price this thing. We're basically going to reproduce this chart that I'm about to show you. Okay. So we're going to have the times at which the future cash flows take place. The cash flows, remember, we're pretending that this is a bond. So we get 4 coupons and a repayment of principal at the end. We've already seen the floating rate note as of time t equals 1/2 has a value of 103.5. The discount factors are calculated, as we'll see in Excel, from the LIBOR curve. And that's used to calculate the present values, which in turn add up to these numbers. All right, so finally, at last, we can use Excel. This is what we've been dying for quite a while. All right, so yeah, let's go back to our spreadsheet now. This is the interest rate swap. All of the constants are listed here. Let's see. The fixed rate bond, oh man, this is a different example, isn't it? That's all right. You know what? We can change it. I just realized I don't know why this template has a different example here. You know what? Why don't we let's see. I'll tell you what, you know what I'm gonna do? Oh man, let me just look at my files here. I wonder if I sent you the wrong one. Yeah, you know what? I think this is the one. I'll tell you what, let me send this out to you. I think that one was meant for a different problem. The one that says assignment 3 template. This one that says swaps template V3, this is the one we really wanted. The reason why I'd rather use this one, I think, is because the numbers are already there. We can just go through and see how they were calculated. And you can see they do match. I think, let's see. Huh. No, I'm not sure what this, it looks similar. I'm not sure what happened here. Try this one. No, this is the same one. That's very strange. All right, you know what? Let me send you this one. I think we'll use this one because it looks like it's almost, for some reason, it doesn't seem to be exactly the same as what we have in the slides. It's close. It might just be rounding. I have a feeling that that's what this is. So I'll tell you what, let me send this off to you. Swap template V2. Let's use that one. That way it'll speed things up a little bit because the calculations are already there. All right, hold on 1 second. If we have to change anything, it would be easy. All right, so yeah, let's take a look at this. All right, so it says here IR swap. So the notional was $100 million. Let's just confirm all of this. All right, so 6 months ago, 4-year swap, $100 million, 5%. The coupon is therefore $5 million on the fixed side. The floating rate side, it has to be 100 million. The coupon is currently 3.5% because, well, let's see why. I think it got slipped in here somewhere. There we go. There it is. I completely overlooked this. Suppose that 1-year LIBOR at time T equals -0.5 6 months ago was 3.5%. Okay, that's where this is coming from. We already know, based on this timeline, that when 6 months rolls around, the coupon will be 3.5% of 100 million or 3.5 million. So these are the times, these are the cash flows. Now, this is the fixed rate bond. There'll be coupons of 5 million. And in the last period, we also get our $100 million back. The floating rate note, we're assuming, because this is 6 months from now is a reset date, that we can treat it as a bond that has just matured with a face value of 100 million and a coupon of 3.5 million. Now the LIBORs are down here. Where are these coming from? Okay, so you can see the Excel function for e to the x is exp. So remember, it's e to the minus rt. The r is coming from this column. The t is coming from this column. So the discount factor is basically telling me the present value of $1 received, in this case, in 6 months, when the continuously compounded rate is 4%. So remember, these are meant to be continuously compounded rates. That's why they have to be calculated this way. We'll do the same thing for all 4 of these. Now, this part is easy. You just multiply these cash flows by these discount factors to come up with these values and add them up. Now, if you notice, I think that the issue here is that in the slides, we're using 100 as the face value. So there's some rounding going on. Yeah. This is what Hull does in this book. But here I'm using the actual millions. And so that's why you notice here it turned out to be 100.59 million. That's pretty close here. That is due to rounding. By using all the millions, I've got the actual number of decimals that I need, whereas here it's getting rounded. Now, I do the same thing for the floating rate note, but this time I only have to discount it once by this discount factor. And that is the value of my floating rate note. And so therefore, you can see for the fixed rate payer who's long the floating rate note and short the fixed rate bond, the swap is worth about $850,000. And here we got 0.86 million, which is roughly the same thing. Yeah. Then this one has to be the opposite. And so these two have to add up to 0. So that way, now remember, this is an over-the-counter product. If the two sides agree to unwind the contract, they can certainly do so, but the fixed rate payer would expect to receive $849,542.79 in exchange for doing that. They wouldn't just say, oh, don't worry about it. You owe us $850,000, but we don't care. We'll close it out if you want to. No, it doesn't work that way. So if you were to look at, let's say, a Bloomberg terminal at the swap, it would show that the fixed rate payer is long $849,542.79, and the floating rate payer is short. But they always have to add up to 0. Okay. So now, of course, there aren't any actual bonds involved, but we can price the swap as if there were. We just have to keep track of who owns the floating rate bond and who is short the fixed rate bond and vice versa. All right. So what's next is going to be the currency swaps, which are a little different because, first of all, they're based in 2 different currencies, which means we have to get exchange rates involved. Then we also have to keep in mind that usually there's 2 fixed interest rates involved. So in other words, you might find yourself trading pounds for dollars based on the difference between the pound rate of interest and the dollar rate of interest. And then also, because these amounts are in different currencies, we often see the notional being exchanged in these cases, which you do not see typically with interest rate swaps. So this one is actually a little bit more involved. So we have to be very careful with it, but ultimately a currency swap can still be treated as the exchange of a position in a bond denominated in one currency for a bond denominated in another currency. So in that way, it's very much like what we did with the interest rate swaps. But there's also other ways of doing this as well. So, and if you look in your, yeah, here it is. If you look in your spreadsheet, swaps template V3, which is already taken care of for you, you might as well use this one. You can see how we calculated the price of a currency swap for the long and the short positions. Okay, and what I've done here is I've shown you an equivalent alternative way of getting to the same results. So I'll tell you what, since it's 7:30, we might as well have our break before we dive into the currency swaps. And when we're done, we'll have priced them in 2 different ways. And that will be that. And then next week, we can start delving into options. And we're going to spend a lot of time with options, not just 1 week like here. We're going to be spending most of our time with options because they're so complicated, but they're so powerful. We want to understand everything there is to know about options. Okay, so for here, we'll stop right now and we'll take a break. And we're going to find out how to price a currency swap in 2 different ways. All right, I'll just see you all in a little bit then. All right, here we go. So now we can take a look at this currency swap. And again, the currency swap typically is based on fixed fixed interest rates, but based in two different currencies. So the purpose of a currency swap is to hedge the foreign exchange risk from owning, let's say, a foreign bond. Okay, that would be a classic example of this, or from receiving interest payments from, let's say, a loan made in a foreign country. So now here, though, we do need to trade the notional principal because they're in different currencies, and the two sides may actually need the currency to do something like buy a foreign bond or invest in a foreign company. So that means that the credit exposure is that much greater. And it's a little bit more complicated to price. So imagine the following situation. A US corporation wants to invest in a 5-year, 100,000 pound bond with a 6% coupon rate issued by a UK corporation. Now, the problem with doing something like this is that if they buy this, they have to convert their dollars into pounds, and they're going to receive pound payments for the next 5 years. And we don't know what the exchange rate will be between the dollar and the pound during that period. And anytime the dollar gets stronger, that will reduce the dollar value to this company of having British pounds. Okay, so in other words, you might have a very nice coupon rate from this foreign bond, but if the dollar just gets stronger, that's all it would take to reduce or eliminate any profits you might make by buying this bond instead of simply buying an American bond. Now, if we buy the bond, 6% of 100,000 pounds is 6,000 pounds a year. So let's say that at the moment, the exchange rate is $1.90 a pound. All right, well, now that hasn't been the case in many years, but let's just say that the exchange rate is $1.90 per pound. So that would be worth 11,400 US dollars a year if the exchange rate stays at that level. If the dollar appreciates to $1.80 per pound, which is not that much of a change, that reduces the value of this coupon to 10,800. So they want to buy this bond because the coupon payment is much higher than what they could get at home. But they don't want to deal with the foreign exchange risk. So here's what they can do. They can enter into a currency swap with a dealer in which they pay a fixed rate of interest based on a notional principal in pounds, and in return received a fixed rate of interest based on a notional principal in dollars. So again, it's both fixed, but one is dollars, one is pounds, and they're not necessarily the same rate. In fact, they're usually not. It's kind of unusual for two different countries to have the same interest rates, although it does happen. So, all right, now let's just say that we go ahead with this and we bought the bond, and now we're going to enter into a swap with the dealer. And the trade is that the dealer, we're going to pay 6% in pounds to the dealer, and the dealer will pay us 5% in dollars. So I think here it is. I knew I had a diagram here somewhere. I find that it's difficult to visualize what's going on without a diagram. Now, this one we have to be careful about because the original bond was worth 100,000 pounds, and the exchange rate was $1.90 per pound, which is 190,000 US dollars. So in addition to these interest payments, what also is going to happen is the bond is purchased for 190,000 is traded for 100,000 pounds to buy the bond. And then at the end of each year, the corporation pays 6%, which means, let me just pencil this in here, because the notional in pounds is 100,000, this equals 6,000 pounds. On the other hand, though, because the dollar value of this bond is 190,000, 5% of that is, let's see, let me get out my calculator. $9,500 US. Now, the US corporation is also receiving 6,000 pounds per year from this bond. So the corporation earns, so they collect 6,000 pounds from the bond, which they then pay to the dealer. But then they collect 9,500 from the dealer. So they're basically getting $9,500 in interest payments every year from their position, in spite of the fact that they bought a British bond. And since 9,500 is 5% of 190,000, this means that the US corporation earns a 5% return in dollars instead of 6% in pounds. Why are they doing this? To get rid of the risk. But still, now they wouldn't bother with this unless they are getting still 5% in dollars is probably more than they could have gotten with a domestic bond. So they must have made the decision, let's take a chance, let's buy this foreign bond at 6%, and we'll swap out the cash flows to lock in a 5% rate of interest when you combine the bond with the swap. Okay. All right, now what we're going to do is now jump ahead and put this into our, oh, here we go. Let me jump ahead now. We're going to price the swap in one of two ways. We're going to treat it as a portfolio of two bonds, one in each currency, or as a series of foreign exchange forward contracts. So let's just say that in the US, the US yield curve is flat at 3%. Now, Hull loves to do this in his book. He loves to assume that the yield curve is not only continuously compounded, flat means it's 3% for every maturity. So that's what it would look like. That means the yield curve in the United States is 3% flat across the board, and it's continuously compounded. In the UK, it's going to be 5. Okay, so how in the world do we price this thing? Now, this is where we're going to look at our spreadsheet. So we're going to do this. Here is the table that, let's see. Yes, so let's switch over to the spreadsheet so we can see. I mean, this is fine, but we can't see the formulas. So we start by assuming that the bond was selling for 190,000 US or 100,000 pounds in the UK because of the exchange rate of $1.90 a pound. Okay, so in other words, the bond is actually selling in England for 100,000 pounds with an exchange rate of $1.90. That means we're actually paying $190,000 for it. Now the coupon is 6%. Actually, no, wait a minute. Sorry, the British bond that we bought is 6%, which means 6,000 pounds, but at $1.90 a pound, that works out to $11,400. The British bond no, sorry, the US rate Oh, right. I'm sorry. You know what? Because what we're doing here, I almost forgot. The swap is being priced as if U.S. corporation is selling a U.S. dollar bond with a face value of 190,000 and a 5% coupon, and using the proceeds to buy a UK pound bond with a face value of 100,000 pounds and a 6% coupon rate. Okay, so let me just save that. Okay, I just want to make that crystal clear. So that's why this information is here. This is what we bought, the 6% bond, which is worth either 6,000 pounds or $11,400. And here over here, it mentions the two interest rates in the two countries. The bond that we have supposedly sold is a 5% US bond based on a $190,000 face value. The coupon is $9,500 or 5,000 pounds. So we're going to create a table where we show the cash flows to the two bonds. For example, over here, here's the US bond, the one that we've sold. So each coupon is worth 95 at the end. Because the face value of the bond is 190,000, the owner of this bond will collect not 9,500, but 199,500. So whoever owns this bond is getting a coupon of 9,500 a year for 5 years, plus repayment of the principal of 190,000 in year 5. Now, because the US rate is 3% compounded continuously, these are the present values. Okay, so let me just quickly show you how that's being done. This is e to the minus, now P1 is way over here somewhere. That's the US rate. And T is this time period. And then all of this is being multiplied by this cash flow. So these are all present values. So when we add these up, that means right now to buy this bond, you'd expect to pay $206,985.33. Now, the cash flows in the British bond are 6,000 pounds every year. That's the coupon, plus a repayment of principal of 100,000 pounds at the end of the 5th year. Now, here we're present valuing them with the 5% rate because that's the British rate of interest. So we add these up to get this number in pounds, but again, assuming that the exchange rate is $1.90 a pound, this is the dollar value of the British bond. So now remember, the US corporation owns the pound bond worth 197,155.24 and is short the dollar bond worth 206,985. Therefore, the position of the US corporation is 197,155.24 minus 206,985.33, or, and so the difference is approximately negative 98.30 dollars. So if that's the case, the swap is worth, the swap is worth that much money. So that means the dealer's position is worth positive 98.30. Okay. Let's see. Hold on one second. Let me just look at the notes for a second. I think I wrote this. Wait. Let's look at this graph for a second. The corporation is receiving, oh, I see, the swap, okay, I get it, I wrote it backwards, okay. The swap itself involves receiving dollars and paying, okay. So I've got this part backwards. The US is selling or buying, I should say, a dollar bond and selling, yeah, and paying for it by selling, okay. All right, so I did have that backwards. So therefore, US corporation owns, or is short the UK bond and is long the dollar bond. Therefore, their position is the opposite of what I just said. It's 206,985.33 minus 197, 155.24 equals positive 98.30. So they're happy right now with this swap. All right, that's better. So what I should do, this is the part that I really should have added. In the swap, the US corporation is short the pound bond and long the dollar bond. Okay, that was the key detail. The swap itself is equivalent to the US being the short pound bond and long the dollar pound bond. So their position is worth 98.30. The dealer is in the opposite position, which means negative 98.30. All right, and then here it's laid out a little more clearly. And again, it's because the corporation is paying pounds to the dealer. In fact, let's get this picture in here. It's so confusing to go back and forth. Ooh, what's going on here? All right, so in the swap, US is paying pounds, which means that we would have sold the pound bond. We're receiving dollars, which means we own the dollar bond. Okay, now we're all set. Now, how else can we price this thing? We've got one more example here. We're going to be involved here with forward contracts written on foreign exchange. And you might recall, we went over this the first week, and we saw that in general, the price of or the forward price for any asset where there's some kind of a cash flow being made to the owner is often written in like this. So that's the forward price of an asset with a yield or income flow to the owner of Q. Okay, Q is some rate of return. If we're specifically talking about currencies, this S is a currency. Or actually, what I should say, it's not, it's actually the spot exchange rate. And that could be, for example, dollars per pound. And then this is that would make this the US rate. That would make this the UK rate. And this is the maturity of the forward exchange rate. Okay, remember the exchange rate, the forward exchange rate is delivered at some point in the future. So I'm going to call that the maturity date. Of F. And of course, F is the forward exchange rate. All right, this is, and remember, we also call this interest rate parity. And so what we're going to do is assume that in the course of a foreign exchange swap, we're going to have 5 different forward contracts, one maturing on each date during the lifetime of that swap. So there'll be 5 different forward exchange rates, once for each time at which the cash flows are exchanged. So we'll go back to our table, and we'll see that you have the same data here. There's the formula in case you forgot. And so this part is the same. And so is this. These are the 2 bonds. And remember, we noted in the last case that the US corporation, the swap means the US corporation is long the dollar bond. So we'll make a note of that. And short the current pound bond. Now, what's different now, if you notice, is that we're not going to simply discount these future cash flows. We're going to do something a little bit different. We're going to do this. We're going to say, well, listen, the implied forward exchange rate on each of these 5 dates, they're all here and they're coming from this formula. And so what we're basically doing is saying, well, if this is the rate that we can lock in, that means as whoever owns this pound bond could enter into a forward contract to exchange 6,000 pounds in 1 year for $11,174.26 because of this forward exchange rate. Similarly, the year 2 coupon of 6,000 pounds could be exchanged in this contract for $10,953. So you see what we're doing here is we're taking the pound cash flows and converting them into dollars using forward exchange rates. And then we can compare them directly to each other. So when the dollar amount is less, the dollar pound amount, the dollar bond cash flow is less than the pound cash flow, the corporation is negative. They are losing, they're behind. But in all the cases but one, the cash flows of the pound bond were higher. But in this last case, they were lower. So we add these up. Now, this number by itself doesn't tell us a whole lot. What we have to do now is figure out the present values of these cash flows. And how is that being done? With continuously compounded rates. We're going to use the US rate right here, 3%. The time is right here. And then finally, we're multiplying that by this amount. That's why these are all red, because we're basically calculating the present value of these cash flows using the US rate of interest with continuous compounding. And when we're done, we add them up. And now, at long last, this is the value of the swap to the US corporation, which implies that the negative of that is the value to the dealer. All right, so we just basically did this in a slightly different way. They're both equivalent to each other. All right, so that's all. Now, I think that there's also a discussion in this chapter of some other types of swaps. Let's just, here they are, but this is just a very brief overview. We start by looking at some other ones. For example, we have equity swaps, where what's happening is that we're trading the total return to a stock, including capital gains plus dividends, for some floating rate of interest. We could take either side, depending on what we expect to happen to the stock market. Now, by the way, if this standard swap means trading the return to stock for a floating rate, you can be sure that there also exists a swap where we can trade the return to the stock for a fixed rate of interest, of course, but this is the more common type. Ultimately, what happens here is it depends on what we're trying to hedge. Right? If we're worried about the return to our stock portfolio because interest rates are going up, well, you know what? We can trade the returns for some floating rate of interest. So if rates go up, we're okay with that because we're getting a higher rate of return. We get the floating rate, which is going up instead of the equity return. All right. Oh, here's a quick example. A pension fund owns $1 million worth of IBM stock. In order to avoid the risk that IBM stock will suffer losses in the near future, look what we can do. We can pay the return to our IBM stock to a dealer in exchange for LIBOR. So if rates go up, well, of course, the difference is traded between them. The fund is exchanging the risk of the stock falling for the risk of falling interest rates. So in other words, if rates go up, which may send the stock market down, we're going to benefit from that. All right. And of course, there's many other possibilities here. Commodity swaps. A commodity is a standardized product where we don't directly consume it, but it is used to reduce consumer goods and services, typically, like it could be financial, it could be, for example, gold or silver, or it could be crude oil, or it could be agricultural, like wheat or oats or any other type of grain. So whatever it is, it's a standardized product. It's in strong demand. And we can have a fixed for floating rate commodity swap or a commodity for interest. Now, ultimately, these are all based on the returns of the commodities. There could be many commodities underlying the swap, by the way. It isn't necessarily one. It could be a basket of commodities. And there do exist commodity indexes that we can use for this. Let's see, I think, there it is. The Commodity Research Bureau produces an index called the CRB Spot Index, which includes the prices of many different commodities, like metals and textiles and foodstuffs. So with a fixed for floating commodity swap, it's similar to a fixed for floating rate interest rate swap, except the floating rate is tied to the commodity index rather than LIBOR. All right, so you're kind of gambling on the future direction of commodity prices when you enter into something like this. Or else, you might be concerned that you own commodities and you don't want to lose money. So you might want to trade the return for a fixed rate of interest. Okay, so there's a lot of ways we can use these. Commodity for interest means you're basically trading the returns to an a commodity index for a floating rate of interest. And then we have forward swaps, where this is just like any other forward contract, except it gives you a legally binding obligation to enter into a swap at some point in the future. But what we're locking in here is the swap rate. Okay, so in other words, if I decide to enter into a forward swap on, let's say, gold. No, actually, it could be anything. It could be a bond. It could be anything. The part that's being locked in is the fixed rate or swap rate. So for example, the long forward swap, the holder is obligated to enter in a fixed for floating rate swap as the fixed rate payer, where the rate itself is specified in the forward contract. So basically, you're saying I need to enter into a swap in the future, just not today. But I don't want to wait to enter into a swap in the future. Why don't I enter into a contract where I can lock in the fixed rate that I will pay in the future? And that's what this is for. So in other words, it's for people who need to get into a swap in the future, and they want to lock in the fixed rate that they'll be either paying or receiving. The short forward swap means that you're going to be the floating rate payer, fixed rate receiver, but you're still locking in that fixed rate of interest. All right, so there's many others. This is just scratching the surface. Now, one thing I do want to mention is that next week we're going to be looking at options. Now here, we've already briefly introduced options. Here, we're going to be taking a much more in-depth look at options. As you can imagine, because they're so much more complicated, we're going to need to spend a lot more time understanding how these are structured. And also we're going to, for the first time, look at some basic option strategies, as well as understand how to determine how much you can make or lose by buying options. So we're going to thoroughly analyze options. Now, I did mention once before that unlike the other types of derivatives, options actually have a price. Okay, and so we're going to spend a certain amount of time understanding how options are priced in the market. And that's where the rocket science gets, mixed in, but it's okay because we can do all of this in Excel. So Nobel Prizes have been given out for option pricing theory, but, and it's a very complex area, but we can reduce it to some relatively simple equations and some very interesting graphs, which will help us understand how options are priced and also how they're used in the marketplace to either hedge or speculate. Okay, and then we'll be looking at some special measures that are designed to help us understand how sensitive option prices are to different factors. And so this is going to take up quite a while because options are such a complicated product, but I think you'll find it to be extremely interesting. Okay, very interesting. So, all right, I'll tell you what, even though it's a little early, why don't we stop it right about here? We don't want to encroach on next week's material. I kind of figured the swaps chapter wouldn't take quite as long as the others. It's not quite as involved, but I think once we get past this point, when we get into the options, we'll need the whole period every time to cover all this wonderful material. All right, so I guess I'll see you all next time. Now, I just realized too, I never sent out an assignment for week 3. And on top of everything else, I never sent the slides. I did send out the invitations, not the slides, not the templates, and not the assignment. So I'll send out the assignment as soon as we're done here. So you'll have the slides, the template for this week, which you can work on if you want to, and you may need it to do the assignment as well. So I'll send that out so we're all caught up. And then next week, I'll try to remember to send the stuff out further ahead. And in fact, I think I'll send week 4 stuff out tonight along with the chapter 3 assignment, just to make sure that we don't forget. Okay. So as usual, try to have everything done within a week, and I'll see you all next time. Okay.
Awesome. Thank you.
All right. Good night.
Thank you. Good night.
All right. Bye.